Hi traders, in today's video I am going to talk about why short-term trading is related to gambling very much, and this is going to be 5 points that I think the most important factors why it is close to gambling. And I want to make this video because I get so many questions about scalpers, even day traders, and robots that are making decisions based on very short-term fluctuations. And the first key point is short-term trading involves higher risk because you are making decisions, or your EA is making decisions based on highly volatile market conditions and big fluctuations. And I see traders over and over again blowing their accounts, like even sometimes 2 times a week or 2 times a day. And they are all trading short-term strategies. I have never seen a trader who use like a long-term strategy with money management who blow its account 2 times a week or even 2 times a year, or the even if the strategy was very, very bad, because you can protect yourself from blowing the account almost 100%. Of course, we are talking about probability theory here, so there's a probability to blow the account, but it is very small. And if you are using safety measures to your money management system to block more drawdown than, for example, 5%, then you are much, much safer. The second is short-term trading relies much more on luck than analysis most of the time. And patterns repeat themselves in a much higher scale on the lower time frames in short-term trading, but their precision is much lower. For example, like with a very complex pattern on the daily time frame, it is like 70% that it is going to be fulfilled, but on a lower time frame it is only somewhere around like 50% or even like 20% that it is going to be fulfilled. And if it is 20%, then you have to have a so big risk to reward ratio that you usually don't have when you are trading short term, because most traders, when they are doing short term trading, they are using like bad risk to reward ratios, so like bigger stop losses than take profits. Actually, like the mathematics doesn't add up. Short-term trading involves high levels of emotions, much higher levels than long-term trading, because long-term trading is kind of boring actually. Even if you are profitable, or if you are unprofitable, it is boring. And as one of my favorite huge, like extremely good investors said, you do trading right if it is kind of boring after a while. If it is so exciting that you can't sleep, can't eat and stuff, you are actually gambling. And I know many of you know this feeling. And so short-term trading is much more emotional based, because it is the human brain that works in a way that reacts to like bad situations with a high intensity, and also to rewards with a high intensity. And especially if it happens fast, your reaction is so much more different. And in long-term strategies, your rationality what comes first and not your emotion. Also, and it is a fourth reason, short-term trading involves speculative thinking much more than long-term trading. Like, of course, every strategy is speculative, but in short-term trading, you rely much less on the actual value of the asset. While in long-term trading, you are valuing the asset, and you create a real thought process about what kind of direction the asset is going to go. Right? In short-term trading, most of the time, most traders are just open a trade because they got told them to open a trade, or just because like one or two indicators told them to open a trade. And also the chances that traders don't follow their strategies are much higher on lower time frames based on statistics. So you have to also consider that as well. And finally, the fifth reason is, and it is huge, impulsive decision making and short-term gains. Like when you are trading short-term and on lower time frames, you want to be the market for a quick amount of time. You want to make like 10 or even 20 profitable trades in a day, and you risk much more than you should. And it is observed in studies, and it is a high correlation with gambling, insanely high correlation with gambling, because you take excessive risk to make, profits. And then when you made profits, you take an even bigger risk, and then you lose everything. But the fact that you once earned money gives you the psychological illusion that you are a good gambler, like you are making money. And after a year, when you just sum your wins and losses, it turns out you are not profitable, but you feel that you are profitable because sometimes you win. There's so much psychology in short-term trading that it is actually like gambling. And 99% of the market, and even more actually, if we calculate it in a real way and not the statistics that brokers give, because that is that is the way as governments calculate like average salaries instead of median, and it is how everybody who knows statistics calculate statistics if they want to make people believe something that is not necessarily completely true. And so more than 99% of the market, of traders in the market, are losing money. So long-term trading, just look up studies, and if you are curious about how I find these studies and stuff and the resources, let me know in the comments, because I can make videos about that as well. How to find studies and statistics about these topics, because it is interesting. I hope this video was useful for you. Ciao.